Good morning. Thank you for the introduction. I wanted to talk about countercyclical policy. Countercyclical policy is somewhat of a philosopher's stone for macroeconomists. We all try to achieve the policymakers, the economists try to achieve the combination of policies that would reduce the business cycle, reduce the effects of the business cycle on the economy, reduce the magnitude of the shocks, and this goal has proved to be elusive over the years. And in the case of Kazakhstan, it is especially so. And this is what I want to talk about. Some constraints are external, some internal. Let me first talk about external. External would be, in the case of Kazakhstan, Kazakhstan is a resource-based economy. The bulk of our exports is oil, and you can see the effect of the oil price on the fiscal position of Kazakhstan. These are the revenues, public sector revenues. You can see broken down by national fund revenues and the revenues of the budget taxation. Both have strong relation with the oil price, and the slope is much greater for the national fund revenues. So how do you implement? So what would be the first idea about countercyclical policy in an economy like Kazakhstan? Of course, you create a buffer like a national fund that has been created. So that is an intentional policy. That is a tool designed to implement a countercyclical policy. And the idea is that you can fill this buffer during the times of plenty, when the oil price is high, and draw from that buffer during the times of scarcity, when the oil price is, when the oil is low, revenues are low, so you can draw from the buffer. And that has been implemented, but not exactly in that form. There is a rule that that the budget can draw a certain amount from the buffer. To be more exact, it's 8 billion plus or minus 15%. It's but the rule is not much of a countercyclical. It's a very small sensitivity to the oil price. In fact, it's very there are problems with this rule. The main external problem for conduct of countercyclical fiscal policy in that context would be what Ricardo Hausman called a non-adjustment. And this has been demonstrated for the case of Venezuela, when Venezuela was spending lavishly the government was spending lavishly, and during the times when the oil price was high, but then could not support the spending and kept on spending when it could not afford that, and that resulted in a sharp deterioration of the fiscal position. So the question is the question of judgment. When do you stop spending? How do you adjust the spending? How do you adjust? What should be the rule? And that question in the context of Kazakhstan has not been answered, or has been answered, but the answer does not provide either the sustainability or the countercyclicality. But today I want to depart from the more important, probably more important, from the fundamental, from the real side of economy, fiscal countercyclical policy, towards monetary policy, and whether monetary policy is countercyclical or not. Monetary policy is generally tasked with three objectives: price stability, growth, and financial stability. And these objectives, to a certain degree, have a conflict between them. You're trying to achieve one, you compromise on another. But it has been recognized in the recent decades that the price stability should be the primary objective, in a sense that if you don't achieve price stability, in the long run you compromise the other two objectives. And that transformed into understanding that central banks should have a primary objective, and other objectives should be specified as complementary. Mandates of the central banks have been revised. Many central banks have become so-called inflation targeters. This is their main objective, and the policy, the decision-making process, the responsibility, the entire institutional setup has been geared towards achieving price stability. How can you achieve price stability? Well, there are roughly two ways in practice for a developing country like Kazakhstan. The menu is very simple. You target inflation, you target exchange rate. Inflation seems a more difficult choice because, well, for a number of reasons, but the exchange rate seems to be very attractive because it is simple to achieve. It is probably the most watched price in the economy. If you go on the street and you see the exchange rate everywhere, you ask people, what is the exchange rate? And everyone knows that. If you ask about inflation, well, the answer is different. And it's usually different from the official statistics. So there are many problems with inflation targeting, especially in the context of Kazakhstan. But the problems with the exchange rate, with the fixed exchange rate, the idea is you fix the exchange rate to the currency, which is, has a stable value, and then your national currency becomes stable as well. The problem with this is that this is not very credible, and the experience shows that we deviated from that. We broke that promise, we broke that link a number of times. The problem of lack of credibility is the regime is highly procyclical. The exchange rate appreciates during the good times, and during the bad times, when we see the decline in the price of oil, the central bank keeps the exchange rate stable. When you want to adjust and you want to keep the competitiveness of your domestic economy, of your producers, on par with the rest of the world in the changed circumstances. So the only way to do that would be to let the exchange rate to adjust rather than let wages, prices, and so on. So the problem is it is highly procyclical. At certain point, it triggers devaluation cycles. I'll talk about it later. And the regime, the entire regime, not being credible, it leads to dollarization. People face the risk of devaluation. The policy leads to highly volatile interest rates in the money market, and there are many other problems. But I also want to point out one last problem in this list. It's a slippery slope argument, is that when you fix the exchange rate and it's not credible, so what do? If it's not credible unless you use capital controls, unless you use administrative controls. You use so what's monetary economists call moral suasion, and these are all types of instruments which are not consistent with the market economy, and they impede financial development, and they're prone to currency. But is there really the choice? So why people fix the exchange rate? Fix the exchange rate that is one justification for stable exchange rate or fixed exchange rate regime is that it allows a domestic manufacturing sector to develop. But the problem is it really fixed? And if you look at the choice that Kazakhstan made by fixing the exchange rate, look in the space of volatility of the exchange rate and the volatility of the interest rates. You cannot stabilize both. And you can see Kazakhstan is very different from the rest, from pretty much every country in that it has very stable interest rates. Very stable exchange rate. It shows here it's 2% on a 3-month volatility. That's historical volatility. But very unstable interest rates. You know that interest rates have been for a very long time around 2%, and then on certain days, during certain weeks, they shot up to 100%, 200%. And so that's the choice that we made. But the point is, is there really a trade-off between the volatility of the exchange rate and volatility of the interest rate? It would seem to be reasonable if you want to achieve stable interest rate to sacrifice something. The point is, and that's the next chart, when we look not at the short-term volatility of the exchange rate, but at the long-term volatility. And that shows that the stability of the exchange rate is a short-term illusion. When we measure the long-term volatility, Kazakhstan is not much different from the rest of the world, but it is still different in terms of volatility of the interest rates. And this line is a 45-degree line. So we try to achieve something, we don't achieve that, but we lose the stability of the interest rates in the process. So that's not a good trade-off. And that's another chart which shows that the market does not believe in that trade-off. Here is, again, a short-term volatility of the exchange rate. And Kazakhstan, again, is 2%. That's horizontal axis. And all other countries are way beyond 6, 8. And freely floating currencies are all usually about 10, 15%. And Russia is, by the way, there too. This is recent data. But there is also so-called implied volatility, that is volatility hidden in the certain financial instruments. And that volatility shows that Kazakhstan, that the market believes that volatility is actually much higher. That's despite the fact that the government, that the central bank tries to stabilize the interest rate. If you look at financial instruments, you see that the cost of hedging is very high, which suggests that the market does not believe that the exchange rate is stable. And if the market does not believe that, if the cost of hedging this risk is very high, then what are the benefits to the real sector of fixing the exchange rate? We are trying to fix the exchange rate, we get all the costs associated with the fixed exchange rate, we don't get any benefits. So one problem that's procyclicality. It amplifies the shocks. It does not heal the shocks, the external shocks. Here's what happened. This chart shows how the part of the economy that is dependent on the cycle, and this is a green line, grows. That's the growth rate. And then there is a monetary aggregate. That's how central bank, well, monetary aggregate, I wouldn't call this a policy variable. The central bank does not consciously control the monetary aggregate, but it is a function of other policies. In particular, it's a function of the exchange rate fixing. And you can see that during the times when the oil price was very low, and that's 98 Asian, and then Russian crisis, Kazakhstan devalued in March of 99. And look what happened to the monetary aggregates. Monetary aggregates were declining back then. So this is the worst time during the cycle, and this is the time that you should provide liquidity to the system. What's going on? The central bank is withdrawing liquidity from the system, and that's exactly what happens. Look at the yellow line there. It's negative 8%, negative 7%. So why they're withdrawing liquidity? Because they want to keep the exchange rate stable. Soon after the devaluation, what happens? Well, then liquidity goes back into the system. And the same story repeats in 2009. And the story in 2014 is a little bit different, probably because the market did not really expect the devaluation to happen back then. Yeah, it's a different story. But these two devaluations, yeah, it's a response to external terms of trade shock. In both cases, we had a decline in the price of oil. In both cases, we had a contraction of monetary aggregates. In both cases, we saw that the cyclical part of the economy has contracted sharply. And so why would central bank abandon? Why? So this is a different view, looking at the same events from the point of view of the market prices. So how market prices responded? Well, you can see that the light green light is showing the real exchange rate, and that has been appreciating very rapidly during the boom cycle. In both cases, before the devaluation, you can see that the real exchange rate has been strengthening, and the market has been feeling that the tenge was not particularly that the tenge was overvalued, and when the price of oil declines, that triggers a run on the currency. So what happens after the run? You can see the run in NDF prices. NDF prices is the cost of hedging the exchange rate risk, and you can see in 2009 that cost went to about 130%. So this is how it's NDF for 6 months. So 130%, that was about 60. It was a lot more than the exchange rate, the actual devaluation. So what happens when the cost of hedging goes up? It translates through different market channels into the rise of the interest rates. People feel that you could get tenge if you can borrow tenge and then buy dollars. You can earn on the devaluation, and you can earn even on without any risk, because you can hedge this risk with the NDF. So when NDF goes up, and this is offshore market, the mirror process happens in Kazakhstan, and this is the interest rates. For example, overnight interest rates is Tonia. Tonia goes up too. Whenever NDF goes up, Tonia goes up as well. And the connection between these two markets are commercial banks, which contact the traders in London, some offshore markets, and then sell this. They buy NDF contracts there and sell them in Kazakhstan for domestic clients who want to hedge these risks. And yeah, and this economic activity, that's the brown line, is again becomes very depressed during the times of ahead of devaluation, for the devaluation. So why the government, why the central bank cannot keep the exchange rate stable? It has enough reserves, and Usually, the traditional argument was, if you have enough reserves, foreign currency reserves, to buy entire monetary base, then you should be able to maintain the exchange rate at any level. Because the scarcity of the monetary base would result in equilibrium between the two risks. The risk of managing liquidity, or tenge liquidity on the one hand, and risk of devaluation on the other hand. The problem with this argument is, no, the central bank has two objectives, not just fixing the exchange rate, but also maintaining financial stability. And when you start reducing the monetary base, interest rates go up, banks cannot manage their liquidity, central bank cannot provide liquidity to the market, and in fact it abandons its role as a lender of last resort. And this is a ground for bank runs, and this is what we saw in I think March of this year. 3 banks were run on, and the central bank had to come out and tell the public that no, we're going to intervene, we're going to inject liquidity, and only after that the panic subsided. But in the first place, of course, people were concerned that the central bank would abandon this role and would leave the banks without liquidity, because central bank is concerned about the exchange rate. So in the end, of course, the choice of the central bank is to save the banks, because the exchange rate is not that important as the stability of the banking system. But that compromises the credibility of the exchange rate. Another weaker argument why the exchange rate is not fully credible, because you have to care about the real economy, and when you have to care about fiscal sustainability, and when the exchange rate does not adjust to the external shock, you run into problems on the fiscal side, you run into problems on the balance of payment side. People spend beyond their means, country spends beyond its means. And the domestic sector, well, we don't have much export competing manufacturing, but we have some import competing services and agriculture, and that even exporters which produce mineral commodities, they also prefer to see a flexible exchange rate that allows them to compete in the commodity markets, especially during the times when commodities fall. Commodities fall, and then all commodity producers, they are in favor of devaluation. So that what creates devaluation cycles, the fixed exchange rate, and the fact that you cannot credibly commit to a fixed exchange rate. But once you have several devaluations, what the government develops is what Calvo and Reinhardt called fear of floating. Fear of floating is they called it's a knee-jerk reaction to external shock when the central bank begins to raise interest rates. Well, in the case of Kazakhstan, interest rates go up themselves because central bank is concerned about the exchange rate. And every time the central bank is supposed to provide liquidity to the market, what happens is liquidity gets out of the market. Another problem with the fixed exchange rate is that what's called dollarization of liabilities. When you expect the devaluation to happen eventually, what happens, the real sector begins to convert their savings from tenge-denominated accounts, even if they have to lose the interest rates they earned on these deposits. They convert all of these into dollars, and then banks just translate the shock because they have to maintain their neutral foreign currency position. They translate the shock into the foreign exchange market, and central bank has to sell foreign exchange. It's a type of crisis, type of currency crisis, which does not have any hot money leaving the country. It's the type of crisis, currency crisis, where it's the domestic. The dollars stay in the country. They don't leave the country. They just convert it from the central bank into the private holdings. And it's not even the banks. It's the private sector. So if you want to maintain the exchange rate, you would probably want to convince not just the banks, because banks are very pliable and well, then there is moral suasion and things like that. You have to convince the real sector not to convert. You have to convince them that the exchange will be stable. How to do that? Well, again, moral suasion, but it's very difficult. It doesn't work with the public. It doesn't work with the households. It works with government companies, and not always, but still, it's worth trying. And sometimes it's usually what the central banks resort in cases such as this. So what would be the solution to a problem like that? Of course, that's good old inflation targeting. Inflation targeting, we should be realistic about what we achieve with inflation targeting. The thing is, can we achieve price stability? Probably not, but we can achieve something. What are the objectives of the central bank? Central bank should not necessarily create price stability. What it should create is the stability and to eliminate as much uncertainty that is concerned with its behavior. And when you fix the exchange rate, the central bank cannot answer a question, what will be the interest rate next year or this year, and what will be the interest rate if you do that or this. And central bank that is concerned with inflation targeting, first, it can allow the exchange rate to adjust to external shocks so that the economy always lives within its means. We're always competitive. Manufacturing sector remains, the conditions for the manufacturing sector development remain fairly stable. And what is more, you have stable credit conditions. Stable credit conditions because you can refinance if you know that interest rates in the money market will be stable, or at least you know the path for the development or contingent path for the development of the interest rates in the money market. You can translate that into longer term interest rates. And this is done, well, either by banks, what is called maturity transformation, or by investment banks, which is called swaps, interest rate swaps. Well, in Kazakhstan, we don't have interest rate swaps. Well, interest rate swaps recently appeared in Russia. You can swap overnight rate into 1 year rate, but not much more. In developed market, there are long-term funding where you can swap very short-term federal funds rate or any other money market rates into 5-year, 10-year, and 15-year rates. So there are instruments like that. In Kazakhstan, no, there are no. So the problem with, again, one problem with the exchange rate is that there are no long-term tenge-denominated funding. Banks have the problem. They want to lend in tenge, but their liabilities all in dollars. So how do you deal with that? So they don't provide lending in tenge because they can't. They don't understand the risks. They cannot transform short-term funding into long-term funding, and there is no credit flowing into the economy. And the block to all that is the policy. Okay. So conclusions and recommendations. Inflation targeting is just one way of making the central bank's policy more credible, more convincing, and to reduce environmental and funding uncertainty. But there is a problem. If we want to switch to the inflation targeting in Kazakhstan, we would face fear of floating, and that has entrenched. We all look at the exchange rate, and that's a problem. It's a psychological problem. We don't believe the central bank. We don't believe, and that's in our head. We think in terms of devaluation. Will the central bank devalue, or will the central bank keep the exchange rate stable? We don't think in a different plane. We don't think in a plane of monetary policy as it is practiced by normal central bank. And one final thing is, and going back to the fiscal policy. Fiscal policy is always has the advantage of the first move advantage over the monetary policy. It has always more. It is always stronger, politically stronger, and monetary policy always follows the fiscal policy. The problem with developing a credible, rule-based monetary policy, predictable, is that first you have to create a credible, predictable, rule-based fiscal policy, and that is not yet in place in Kazakhstan. And the recent, yesterday there was an announcement that the fiscal rule for the national fund has been changed to increase the transfer, the maximum transfer from 9.2 billion to what, 15.2 billion dollars for the next 3 years. But that does not address the problem of the rule. The rule remains highly discretionary. It's not really a rule. So the problems of implementing a counter-cyclical policy in Kazakhstan are the problems of credibility, problems of capacity, and problems of political, probably will. Thank you.